like Mercury, is constantly in the dark. But that side is pretty ugly. You don't need to see that. It's 2:28 p.m. in Istanbul. We're gonna start in 2 minutes, but I am, thanks to my producers and agents, I am using a new studio program with which, of course, I'm not familiar. Therefore, I have decided to start early to make sure nothing goes wrong, which I'm sure it will, because my life is actually a sequel to Murphy's Law. Expecting a phone call from my agent any minute to tell me that I've completely screwed up. I would be extremely surprised if that phone call doesn't arrive, which might mean he has expired and joined Allah. Today we're going to talk about Turkish Central Bank, its monetary policy, and how it leads to higher inflation and currency weakness. The reason I picked this topic is it's sort of like a lesson in international monetary economics, in the sense that almost every central bank in the world nowadays is easing monetary policy, that's cutting rates or initiating asset purchases. So why shouldn't we do it? What's wrong with our monetary policy? And the lesson here is that unless you have inflation under control, monetary easing doesn't do any good to the economy. In fact, it could be quite harmful. And that happens to be the case in Turkey. Monetary easing, the suspension of most macroprudential rules for the commercial banking industry, and of course, extreme fiscal expansion are a toxic combination even during the age of COVID, because eventually you have to pay the piper. And in Turkey, the long run is measured in days, at most in months. Contrary to what John Maynard Keynes said, in the long run, we're not all dead. In fact, we're all going to be around paying the piper. Okay, it's 14:30. Dear YouTubers, welcome to Real Turkey channel, which is an institution on YouTube. It is the longest running English language politics and economics commentary show originating from Turkey. It is in fact probably the only English language YouTube show originating from Turkey, but nevertheless it's an institution. We have been on air, or whatever it is called on YouTube, for what now? 6 months, roughly 40 videos. Today we're going to talk about Turkish monetary policy. It's May. Our central bank is going to have another monetary policy council meeting Thursday, I believe, though of course my memory is fading. It could be Wednesday. I looked at several surveys. The consensus is that the central bank will cut interest rates by another 50 basis points, even though there's a pretty wide dispersion around the median. It could be anywhere from 75 basis points to no cut whatsoever. If you ask my personal opinion, it will go whole hog and cut interest rates by 100 basis points. If central bank cuts interest rates by 50 basis points, as the consensus expects it to do, then the policy rate, that's the main interest rate central bank charges to banks which wish to borrow from it, would be 8.25% per annum. Whereas inflation in Turkey, as measured by consumer price inflation, is roughly 11%. Now, of course, that means Turkey has a deeply negative interest rate, which is damaging in several senses. A, the deposit rate, TL deposit rate in private banks has declined to lows of 6-7%. The average duration, or weighted average maturity of TL deposits is less than 3 months. This means your basic saver doesn't care about the long-term inflation forecasts or trend inflation. core CPI, it cares about the headline inflation because that's what affects the purchasing power of the money it placed in the bank. Assuming inflation suddenly turns negative by a miracle for the next 3 months at these deposit rates, holding TL deposits is foolishness. Might as well as give it to charity or spend it on a roulette table on the Turkish side of the island of Cyprus, the northern Turkish Cypriot Republic. At least you get free drinks. That's one problem. Such negative interest rates leads to what we call dollarization. That is, it discourages residents from holding their own money. Secondly, of course, it leads to currency weakness simply because hard currency demand exceeds the supply of hard currency. And the fact that we have negative rates ex ante makes Turkish lira very unattractive to funds which invest into countries on the basis of yield and risk. Turkey is already a high risk country for several reasons, political uncertainty, conflicts with some neighbors, with the United States, as well as the COVID outbreak, which is raging in most emerging nations. And this is not my personal viewpoint. What measures a country's risk, total risk, is the CDS price, and our CDS price is roughly 600 basis points, much higher than Brazil or South Africa or India, nations in our league. And if you add to that constantly falling TL yields, which are negative in inflation adjusted terms, obviously money abandons Turkey. And since the beginning of the year, every week bond funds have sold their TL bond holdings, which is a reason for currency weakness. So it is interesting to ask why central bank is doing that. Well, for one thing, even though on paper Turkish central bank is independent in the pursuit of monetary policy, nobody is independent in Turkey, including myself. I ask the palace before I go to the bathroom, and if I don't get approval, I hold it. And central bank is actually an arm of the government, and it does what Mr. Erdogan or his advisors tell him to do. And Mr. Erdogan is notorious for his belief that higher interest rates lead to higher inflation. Ergo, you must cut the interest rates to reduce inflation. He also believes that at lower interest rates, businesses will borrow more and build more factories and buy more machinery, etc., etc. They will increase capital expenditures. It apparently doesn't occur to him or to his advisors that this may in fact be true if there is any money left to borrow in banks, because there will be no one to deposit money in banks at these low rates. So he understands the demand side of funds, but not the supply side. In any case, the central bank doesn't really care about inflation or currency weakness. Its only job is to implement the orders or instructions sent by the palace, and it does so very obediently, very diligently. Of course, we're going to have massive problems with these rate cuts. But let me talk about what else it does in addition to rate cuts. It's also printing money. In polite terms, that's called asset purchases. In other words, the government runs a fiscal deficit. To cover that fiscal deficit, it issues bonds, and central bank buys these bonds, which is what Fed does and ECB does. By itself, it's not a harmful practice, at least not harmful in the context of the massive economic decline that most economies are suffering because of this COVID-19 outbreak. Uh, but in Turkey, things work slightly differently. First, the central bank is funding the fiscal deficit and banks by printing TL, and at the same time, it's using its FX reserves, foreign currency reserves, to stabilize the currency. Why? Because we know from the experience of Fed and the European Central Bank and other central banks that if you increase the money supply, hoping that it will go to demand for goods and services, it doesn't necessarily do so. Part of it does go to bidding up the prices of goods and services or increasing the demand for them. But the second part goes to financial markets. This is why S&P 500 and all the other major equity indices around the world have been rallying constantly since 2009, regardless of the underlying economic or political conditions. It's called don't mess or don't fight with the Fed, or go where Fed goes. So the investors think Fed simply insures them against all the risks and they invest. In Turkey, part of the central bank money does go to the purchase of goods and services through the government. But a good portion of it goes to the Istanbul Stock Exchange, which, despite the disappearance of foreign institutional investors, has performed remarkably well. And it goes to currency market. It doesn't go to the bond market because bond yields are controlled by state-owned banks, and they are also at the level of inflation or lower than the inflation. For instance, what Turkey considers the benchmark rate, the yield on 2-year TL-denominated bonds is 9%. As I've said, the running rate of consumer price inflation is 11%. So why would anyone buy 2-year bonds? You essentially make a gift of your money to the treasury. This is why the main venue for this leakage from excess money printing is the currency market, and the currency constantly weakens. These are the first round effects, but things will change as Turkey suppresses the outbreak, hopefully, fingers crossed, and starts normalizing. In fact, President Erdogan will start the normalization of the economy after the Eid. Right now we're in the month of fasting, Ramadan. It's followed by a 3-day holiday called Eid of Fitr, something like that. My Arabic is kind of rusty. We will have a final lockdown of 4 days, after which slowly and gradually, depending on the level of contagion risk, first the goods producers, then the service providers will be open. For instance, tourism facilities most of them will probably be opened in June. Domestic and some international flights might start in June. So what happens when the economy normalizes? Obviously, there will be a demand, higher demand. And when higher demand meets a fairly inelastic supply, prices go up. And when you have printed tons of money, in fact, I can give you a figure, it's 40 billion liras, or roughly $5 billion. The base money increased by 40% year to date. I am sorry, that's the correct figure. The base money, the high-powered central bank money, has increased by 40% year to date. Compared to cumulative inflation of something like 5%, that's a massive increase in real money supply. As a result, of course, people will spend more. The government will spend more. And we will have another inflationary episode. There's another problem here. remember I said the supply curve is inelastic. That means even if there is no contagion risk, Turkey will not be able to supply at any given price as much as it used to prior to the crises. There are several reasons for that. For one thing, the labor participation ratio is dropping sharply, and we don't know why, but it's very unlikely to return to pre-crisis levels. In the United States, it never returned to pre-2008 great financial crisis levels. Two, even though factories, restaurants, shops, etc. will be open, and this is the right decision, I commend President Erdogan for doing that, until the end of the year at least, social distancing measures will be in force. That means in factories, there will be a bigger distance between workers. They'll be disinfected regularly. They'll be tested for the virus regularly. If, God forbid, a few people test positive, then the facility will be quarantined for 14 days, etc., etc. But all of these means that the cost of production per unit increases, because you are spending more to produce. There's a second problem, which is that we're part of the global supply chain in the sense that we import a lot of raw materials and semi-finished goods, even for our export industry. And the global supply chain is not entirely fixed. There's problems between China and the United States and EU, but nevertheless, not every nation goes to normal at the same time. So there's a lot of tiny disruptions which are actually very damaging to small and medium-sized companies which have to find new suppliers. And Turkey is a small company heaven, so their costs will go up. And finally, in an effort to control currency depreciation, our government has imposed additional import levies of 30% on 830 items of imported goods. Some of these are luxury goods like jewelry, and I couldn't care less. They could put 500% import tax on it. But I just checked through the list today. Most of it is what we call investment goods, things you use to produce fixed investment or to help you produce goods and services. When you increase the cost of those, either these costs will have to be reflected to final prices or less of it will be used. Either ways, you will have a supply curve which doesn't respond to price increases by increasing quantity supplied, but by raising prices. So low interest rates, people having very little incentive to save, and plenty of money swooshing around means that inflation will increase unless we have a second wave of the outbreak and people are locked down into their houses again. Which brings us to the final item in the title, currency weakness. There is a very strong correlation between inflation and the exchange rate, and it runs from inflation to exchange rate, even though, of course, it's sort of a circular event. An inflation shock, that's a sudden change in inflation, drives the exchange rate higher. That's Turkish lira depreciates, loses value. And then this in return has a second round effect through the import prices, which raises inflation a second. It's sort of like a spiral, that loses, its coils over time. But currently, the central bank's own monthly survey predicts something like less than 10% CPI at the end of this year, or in next 12 months, and 9.5% in the next 24 months. And I assume that the actors in the economy, the agents in the economy, are planning and adjusting their currency expectations along those lines. Now, if you suddenly have not 9.5 or 10% inflation, but 15% inflation, or a trend that's going to 15%, or if people believe inflation will go to 50%, then of course they will also adjust their expectations of the fair value of the currency, and Turkish lira will weaken further. I can count other venues through which Turkish lira will weaken. One of which is that obviously, uh, if you have so much money swooshing around, people will demand imported items, and the current account deficit may increase. So, at the end of the day, while it is true that every central bank eases, prints money, in Turkey's case, our central bank has gone overboard. Zero real rates, or perhaps slightly negative real rates, something like 50 basis points, are acceptable, as well as some purchase of government bonds, as long as these are used properly to support people who have lost their jobs. But we don't see that in Turkey. We see the government pretending it has a license to use the central bank as part of the treasury, and the central bank, in addition to that, pursuing an interest rate policy which has no connection to the inflation reality, all of which are extremely damaging to the foundations of the economy, as well as indicative of everyone who wishes to invest into Turkey that we don't have an economic policy. We just have one man who decides day by day, according to his mood, what the fiscal or monetary direction will be. Nobody will put their money in a country like this, and those who live in the country will try to get out or get their money out. In fact, SODEV, a center-left think tank, unveiled a study today which shows that 62% of the youth wishes to leave the country as soon as possible, with or without their monies. This has been another live broadcast of Real Turkey channel, and I am your presenter, Atilla Yeşilada. Please do share. I really don't care if you subscribe or give me a thumbs up. sorry. But do share it with anyone who might be interested in Turkey. And stay home and stay healthy. Yeşilada saying goodbye from Istanbul.